Welcome to The Explainer. Today, we're going to decode something really fascinating, the DNA of history's greatest superstocks. Have you ever looked at the massive, explosive growth of a legendary company and wondered, man, is there a way I could have spotted that before it took off? Well, that's exactly what we're digging into today. We're looking at a completely data-driven system designed to transform stock selection from wild guesswork into an actual, repeatable science.
And you know, this raises a question we've all probably asked ourselves at some point. Is the stock market really just a chaotic, rigged casino? Because let's be honest, for the everyday investor, it absolutely feels that way sometimes. It feels like you need insider information or just blind, dumb luck to actually get ahead. But the source material we're exploring today offers a highly logical alternative. It asks a powerful question. What if success isn't about guessing at all, but just knowing exactly which historical clues to look for?
Okay, let's dive into this. Here's our pre-flight checklist for today to help demystify this entire system. First, decoding market-winning DNA. Second, the core fundamentals. Third, market mechanics and whales. Fourth, the master key. And finally, the art of selling. Let's kick things off with Part 1, Decoding Market-Winning DNA. It's time to put on our financial detective hats, setting up the premise that the market is actually a solvable puzzle if you have the right data.
And this brings us to the architect of this whole framework, William J. O'Neill. The guy was totally frustrated with all the empty hot tips and myths constantly floating around Wall Street. So he did something unprecedented. He built the CAN-SLIM system by exhaustively analyzing the top 1,000 market winners dating all the way back to 1880. He wasn't relying on hunches. He scientifically documented what actually worked in the real world, and he discovered that right before a stock goes on a monster run, it shows very specific, highly measurable traits. Success literally leaves clues. And this brilliantly illustrates exactly what we're talking about. We are looking at hard data here. America's great continuing growth story, mapped out over a 100-year study. Despite world wars, severe recessions, and full-blown panics, the overriding trend of American business and the stock market has been continuous, long-term growth. O'Neill found that inside this massive upward trend, the absolute greatest winners just keep repeating the exact same patterns, decade after decade. Moving right along to Part 2, the core fundamentals. This is the engine of growth, making up the first three letters of the CAN-SLIM acronym, C-A-N. These act as our initial filter to find the absolute best companies in the world before we even think about buying. So the C stands for current quarterly earnings per share. Think of this as the rocket fuel for a stock's price. The system demands a strict baseline, a 25% increase in the most recent quarter compared to the exact same quarter the year before. But here's the kicker. The data showed that the truly historic monster stocks often had earnings jumping by 50%, 70%, or even 100% right before they took off. We are looking for exceptional, undeniable growth. But hey, anyone can have one lucky quarter, right? A clever accounting trick, a one-off real estate sale. That doesn't make a great company. That's why we need A, which is annual earnings increases. This forces us to zoom out. We want proof of a sustainable business model. We're looking for companies showing annual earnings growth of 25% to 50% or more, consistently for the last 3 to 5 years. This proves the company isn't a flash in the pan. It's a proven machine.
Next up is N, which stands for new. Think of this as the spark that lights the fuse. A stock rarely makes a huge move without a brand new catalyst pushing it. We're talking about a disruptive new product, maybe a visionary new CEO, or a massive shift in their industry. But there's a vital technical side to N too. It also stands for new highs. This directly challenges that old, flawed logic of buy low, sell high. The hard data actually proves that buying a stock just as it breaks into a new 52-week high is a massive indicator of true market leadership. All right, Part 3, Market Mechanics and Whales. Now that C, A, and N have helped us find fundamentally amazing companies, how do we know which one is actually ready to launch? That's where S, L, and I come in. Now, what's really interesting about this piece of the puzzle is how simple the economics are. S is for supply and demand. If a stock has a relatively small supply of available shares and suddenly huge volume, explosive demand pours in, the price has nowhere to go but up. Then we have L for leader. You don't want laggards. You want companies with a relative strength rating between 80 and 99, meaning this stock is already beating 80% to 99% of the entire market. We only want the fastest horses in the race. And the I stands for institutional sponsorship. I want you to picture these institutions as the absolute whales of the market.
The giant mutual funds, the pension funds, the massive banks. Look, as individual investors, we're just cruising along on a tiny rowboat. We literally do not have the financial firepower to move a stock's price, and we shouldn't try to outsmart the whales. Instead, we just want to look for stocks where the number of institutional owners is steadily going up. We're just surfing their validated trails after they've done all the heavy lifting.
Actually, let's take a quick pause right here because there is a huge psychological trap we need to address. Think about the massive difference between a noise trader and a process-driven pragmatist. The noise trader is frantic, chasing that dopamine hit from the latest hot tip, acting completely impulsively. But this system, it's designed to turn you into the pragmatist. You follow a disciplined, data-backed checklist, and you leave your ego entirely at the door.
That brings us to part 4, the master key. This is the ultimate gatekeeper of the whole system, the piece that dictates whether you should even be in the market at all.
So the absolutely crucial point here is M, market direction. Listen, you could find a stock with flawless earnings, a world-changing new product, and all the institutional backing in the world. But if the broader market is tanking, your perfect stock is probably going right down with it. History proves that 3 out of 4 stocks just follow the broad market trend. You have to watch for distribution days, heavy institutional selling, and follow-through days that confirm a new uptrend. If the market is bad, you simply protect your cash. Period.
But when the market is right and you found a stock that meets every single criteria, well, that is when you look at the charts. Just look at this classic historical breakout from Microsoft. This is the visual proof of what it looks like when everything aligns. You can see the exact moment the smart money steps in. The price bursts through that ceiling of resistance on absolutely massive, surging volume. That right there is your undeniable entry signal. O'Neill cataloged a few patterns, but the absolute gold standard is the cup with handle. It looks exactly like a teacup in profile. First, you get the cup, a U-shaped dip that basically shakes out all the weak, fearful investors. Then, as it recovers, it forms the handle, a very mild, quiet, low-volume pullback. That handle is your low-risk entry zone. The absolute perfect time to buy, the exact second the price breaks out above the top of that handle on huge volume.
Finally, we reach part 5, the art of selling. Finding the stock and timing the entry is great, but how you handle the exit is what actually dictates your survival.
8%. That is your absolute, non-negotiable hard stop loss. The second you buy a stock, the rule is you sell if it drops 7% to 8% below your buy point. No questions asked, no hoping it bounces back, no averaging down on losers. This rule exists solely to kill the sunk-cost fallacy and guarantee that a tiny, normal mistake never balloons into a portfolio-destroying catastrophe.
On the flip side, how do we lock in the wins? The 3-to-1 profit target. If you're ruthlessly cutting your losses at 8%, you should be taking your profits when your stock surges 20% to 25%. By balancing risk and reward at a 3-to-1 ratio, the underlying math of the system practically guarantees you an edge over the long haul, even if you're only picking right 50% of the time.
And there you have it. We've decoded the DNA of the market's greatest historical winners. The Cancelam framework lays it all out. Current earnings, annual growth, new catalysts, supply and demand, leaders, institutional sponsorship, and market direction. It's an incredible blueprint that proves navigating the stock market doesn't require a crystal ball. It just requires mastering a disciplined, historically validated process. The data's all right there. The rules are crystal clear. So the only question left to ask yourself is, are you ready to stop gambling?